I don't know what people expect after a month when you're up 10% and major averages, 30% for energy.
So, seasonals broadly are kind of in the camp of the bulls, and I think are favorable for the bulls, as is the breadth of the market. But to Bob's point, and one of the things I focused on in my report, in the near term, sentiment has become a problem. And it was in conjunction with what was the initial vaccine news. So coming out of Pfizer 4 weeks ago, that was really a turning point, where we went from sentiment that really since early September, we had seen a lot of speculative froth, but it was concentrated. It was concentrated in the cohort of newly minted day traders in areas like single stop call options. It wasn't pervasive across both behavioral and attitudinal measures of sentiment. But fast forward to the Pfizer news, I really think that in addition to boosting optimism about the pull forward that the vaccine suggests about economic growth, it sort of spread that sort of speculative optimism across most sentiment measures. So in addition to the market having gotten a bit overbought, you then have that frothy sentiment. Generally, when you have still strong breadth, that tends to be an offset to sentiment, and the weakness is a bit more limited. But what I would worry about as we head into the end of the year is if sentiment stays frothy and we start to lose some of that better breadth. That would, I think, represent a bigger risk for stocks.
Oh, that's an interesting way to watch it. So to see if the breadth starts narrowing, and then I hadn't thought about it that way. Can you give us any other kind of glimpses or hints of what your outlook foretells for 2021?
Sure. So, our view about the economy is really not much different than the consensus. I do think the vaccine represents a pull forward of the improvement in economic activity, but the virus represents the push down right now. And, it's maybe a bit of an overused analogy of the vaccine representing the light at the end of the tunnel, but the acknowledgement that we're still in the tunnel. And although near term fourth quarter GDP estimates have been trending a little bit higher, first quarter has been coming down as we're still sort of pre-vaccine in the midst of the virus's impact. And looking ahead into 2021, I think that stretched sentiment, if it persists, sentiment when it gets to an extreme in and of itself isn't indicative of a market that's about to move in a contrarian fashion. We know sentiment at extremes is a contrarian indicator. The timing is tricky. It just establishes greater vulnerability to the extent there's a negative catalyst. And there could be negative catalysts associated with the virus, associated with the vaccine, associated with fiscal relief, not getting it in the lame duck session, maybe less of it than what's anticipated post-inauguration, the Georgia runoff elections. I mean, I could go on and on in terms of what those potential catalysts could be. And they don't necessarily have to be out of the realm of narratives that have been in play all along. It's just that, again, that stretched sentiment means that there's a bit more vulnerability. So those are the key things to look for. And then in terms of the economy, I'd say look for the measurements of scarring, as it's often called. So I think, especially within the labor market, things like permanent job losses versus temporary job losses, long-term unemployment, I think those are the key metrics to watch heading into 2021 to judge the long-term scarring impact on the economy of this virus.
Shepard Smith here. Thanks for watching CNBC on YouTube.